Markets are closed for the session. Opendoor Technologies, ticker OPEN, finished the last trading day at $6.82, slipping $0.14, which is a drop of 2.01%. And while a 2% move in either direction might seem like just another day for a name this volatile, what's happening under the surface is far more significant. The real story isn't this minor pullback, it's the intense, coiled spring tension building as we head toward the company's upcoming third-quarter earnings report, which is scheduled for November 6th. The expectation, the whisper number, the analyst consensus, it's pointing toward a potential catastrophe. Wall Street is bracing for Opendoor to report revenue of just $882 million. To put that in perspective, that isn't just a miss, it would be a staggering 36% collapse compared to the same period last year. That's the kind of figure that usually sends a stock spiraling. Yet here we are, looking at a stock that, despite today's dip, is still up a blistering 368% since the beginning of this year. This is the central conflict for anyone looking at this name, whether you're a day trader using the Interactive Brokers platform or a long-term holder checking your individual brokerage account. The market expectation, the narrative that has fueled this massive rally, is that Opendoor is the last iBuyer standing. When Zillow and Redfin spectacularly flamed out of the iBuying business, admitting they couldn't make the model work, the assumption was that Opendoor, the specialist, had weathered the storm. The belief was that they had cracked the code and would now consolidate the entire market, becoming the de facto way Americans sell their homes. This narrative has been powerful enough to pull the stock up from a 52-week low of just 51 cents. It's a story of survival and dominance. But the reality, the data sitting right below the surface, challenges this story directly. That 368% rally wasn't a recovery based on stellar performance. It was a speculative rebound from the brink of total collapse. The company is not thriving. It is, by its own admission, contracting just to survive. The reality is that Opendoor is still losing massive amounts of capital. The company posted a net loss of $1.4 billion in 2022 and $662 million in 2021. Even in its most recent Q2 report, while it celebrated a slight improvement, it was still deep in the red. The reason Wall Street expects that 36% revenue drop is not because of some external shock. It's by design. Opendoor management has been forced to take a cautious approach to the housing market, which is a polite way of saying they dramatically slowed down the number of homes they are buying. In the second quarter, they sold over 4,000 homes, but only purchased around 1,700 new ones. You cannot grow a flipping business when you are actively shrinking your inventory. This isn't a growth story right now. It's a story of inventory liquidation in a desperate attempt to stop the cash burn. They are selling off the assets they bought at higher prices during the tail end of the boom. And they are terrified of acquiring new properties in a market where there is, according to Redfin, a record high surplus of 500,000 more sellers than buyers. This is the core of the issue, and it's what makes Opendoor such a dangerous investment for those not paying close attention. The iBuyer business model is fundamentally simple. Buy a house, apply a 5% service fee, perform minimal repairs, and sell it for a small profit, very quickly. This model works beautifully in a strong, appreciating housing market, like we saw in 2020 and 2021. When home prices are rising 1 to 2% every month, you are insulated. Your mistakes are covered by market appreciation. But when interest interest rates spiked, the entire game flipped. Suddenly, Opendoor was holding thousands of homes that were losing value by the day. Their gross margin, the razor-thin profit they make on each flip, evaporated. It was 8.3% in the first half of this year, a number that leaves absolutely no room for error. This isn't NVIDIA stock, which sells a high-margin chip. This is a low-margin, high-capital, high-risk logistics business disguised as a tech company. The company's $789 million in cash on hand as of June 30th sounds like a lot, but not when you're losing hundreds of millions per year. This volatility is why you see so many retail traders on the Robinhood app and the SoFi trading platform. It has the explosive potential of Tesla stock in its early days, but it carries a risk profile that is completely unsuitable for a set-it-and-forget-it intelligent portfolio or one of the Schwab intelligent portfolios. This is not a stock you buy and place along your Fidelity mutual funds or Fidelity ETFs. This is a pure speculative vehicle, and the entire bull versus bear debate right now hinges on that November 6th report. The market is pricing two completely different futures. The bears see the revenue collapse as the final nail in the coffin, proof that the iBuying model is fundamentally broken in a neutral or down market. The bulls, however, are looking past the headline revenue number. They are focused on something else entirely, the pivot. Opendoor knows its original model is bleeding, so it's changing the narrative. The new buzz is about an AI-first strategy. The company is trying to convince investors that it's no longer just a house flipper, it's a real estate technology platform. They're leveraging the massive data set from over 250,000 transactions to build what they claim is the industry's most powerful pricing and logistics engine. The new strategy involves partnering with key agents, essentially trying to become a high-margin software and services provider rather than a capital-intensive flipper. This is the story that got Morgan Stanley to recently raise its price target from $2 to $6, even while keeping an equal weight rating. They see potential in this asset-light model. The bulls believe Opendoor can become the central operating system for real estate, a platform that Fidelity or other large institutions might one day see as a legitimate tech play, not just a cyclical housing stock. This is the expectation. The reality, however, is that this pivot is unproven. It's a compelling story, but right now it's just that, a story. The vast majority of its operations are still tied to the old broken model. This shift to an AI-powered agent-led model is a direct admission that iBuying at scale is too risky. It's competing against entrenched platforms like Zillow and Compass, which are also embedding AI into their agent tools. Opendoor's advantage is its transactional data, but it's unclear if that's enough to build a profitable, scalable software business before its cash pile runs out. This is the tension. Is this a genuine strategic shift, or is it a last-ditch effort to rebrand a failing business? This is what makes online investing in names like this so difficult. You aren't just analyzing numbers, you're betting on a narrative. The macroeconomic environment is offering no help. The entire Opendoor model is chained to the housing market, which is itself chained to the Federal Reserve. We are in the tightest interest rate environment in decades. This has created a gridlocked market. Yes, recent data suggests the Fed may be done hiking and is even projecting 2 rate cuts before the end of next year. But that's not the silver bullet Opendoor needs. Lower rates might bring some buyers back, but the primary issue is affordability, which remains at historic lows. Furthermore, Opendoor's model relies on turnover. The lock-in effect, where existing homeowners are refusing to sell because they don't want to give up their 3% mortgages, starves Opendoor of the very inventory it needs. It needs a fluid, high-volume market, and we are in the exact opposite of that. A self-investing enthusiast might look at this and see a coiled spring, but a professional managing funds through Fidelity Wealth Management would see a minefield of macro risks. This is why the daily swings are so aggressive. We saw the stock hit $10.52 in September, and now it's back below $7. That's a 30% drop in just over a month. This isn't investing, it's high-stakes gambling on the future of real estate. Many traders using Fidelity brokerage services or the Robinhood stock trading feature are likely getting chopped to pieces. They see the 368% gain and jump in, not realizing the fundamental ground is crumbling beneath them. They might be using the Fidelity mobile app to buy shares, treating it like Apple stock, a stable long-term hold, when in reality, it's one of the most speculative names on the market. Online investment platforms have made it easy to buy, but they don't provide the investment help needed to understand this level of risk. This is where SoFi Invest and its SoFi Active Investing tools meet their match. No SoFi robo-advisor would ever touch this stock. It's a pure individual brokerage play. As we approach that November 6th earnings date, the key metrics to watch won't just be that headline revenue number. The market will